Welcome everyone to another of our weekly investment manager videos, and many thanks once again for tuning in. I don't know about you, but I'm spending more and more time and energy trying to find areas of value in the bond market. This most important of traditional assets is facing multiple headwinds, including rising inflation and forecasted rising interest rates. Yet with equities seemingly being the only game in town and global indices hitting almost daily all-time highs, bond markets are disagreeing with this buoyant narrative. So what is a guy or gal to do? Well, to give us perhaps an alternative insight into this, I have the huge pleasure of talking today with Jeff Boswell, head of the alternative credit investment team at 91 and manager of their global total return credit fund, amongst others. But first, as ever, before we get into the content, if you are enjoying the channel and the videos, it would be marvellous if you could subscribe to our channel if you haven't already done so. It really does assist us in delivering this content and getting the content out to a much wider audience. So, begging over with and onto the content. Jeff, many thanks for your time today. Cracking straight onto the first question, how are you viewing bond markets at this moment in time?
Hi, thanks, Andrew. So I think you alluded to it in your intro, but bond markets, you look across them, and to be honest, from a headline perspective, they're not particularly inspiring. And whether that be government bonds, which are at multi-decade lows, or whether it be parts of the credit market where yields are again certainly at post-financial crisis lows, in some markets touching all-time lows. Partly driven by the collapse in government bond yields that we talk about, but partly also because credit spreads have come a long way and recovered, to again those levels of post-financial crisis lows in most markets. The interesting part of it is that actually when you peel back the layers of the onion, you can appreciate that actually the rally that we've seen over the bond markets has actually not been very uniform. Mm-hmm. So if I pick high yield as a good example, the last 6 to 9 months has really been led by the lower quality subset of the market. So lower quality has driven that rally. And what that's done is it's made the headline spread level and yield level of the market look very expensive. But interestingly, when you actually look at the underlying market, there are parts of it which aren't that expensive. So for us, there still are opportunities out there, but it really varies market by market. Some markets are very expensive and undoubtedly vulnerable, and we'll talk about some of the risks, no doubt. But there are still some opportunities there, but it really is about having, in our mind, a broad opportunity set and the willingness to peel back those layers of the onion and understand where the real value is.
Yeah, looking at those particular opportunities, is it a case of actual real return opportunities, or is it just a case of damage reduction at this moment in time?
That's a very good question. Yeah. So I suppose given how far markets have come, your potential for convexity, your upside potential from here is admittedly fairly limited, because spreads have tightened in as much as they have. But from our perspective, to what I alluded to earlier, there still is the potential to actually earn some fairly attractive carry. So granted, I suppose it's adjusting your perspective, where granted we had this significant opportunity in March of last year, that the game has now moved on, but you can still earn undoubtedly, in our mind, attractive carry, in the year ahead. And granted, parts of the market, what I was alluding to earlier, you still have a little bit of upside potential in terms of maybe a bit of spread compression in the parts of the market that haven't rallied as hard. There are risks to think about, to your point about damage controls. So there are undoubtedly risks, whether that be, you alluded to it earlier, but rising government bond yields, that's a real risk to the extent that you are either invested heavily in govies or in the investment grade market, which is very susceptible. Be it the potential for ebbs and flows in economic activity as we reopen up, and the impact that has on financial markets and credit markets in general. But in our mind, again, picking your spot, there is undoubtedly, it's not just about damage control. You can earn attractive carry and actually do so in a manner where you're not getting over your skis from a risk standpoint, to the extent actually some of those risks do manifest themselves.
Yeah. Now, with regards to the size of the bond market, the global bond market, it's absolutely huge, and you need to have a real significant skill set to be able to analyze all the options available to you. Looking at your fund in particular, the Global Total Return Credit Fund, where are you currently positioned at this moment in time? What opportunities are you seeing?
Yeah, so our fund, we purposely have a very broad investment universe. And the idea behind it, very much, I suppose, what we've been talking to is, in different environments, it's great to have different levers with which to manage the fund through. So, if parts of the market are very expensive, we can just ignore those and we can go find, more attractive parts of the market where we feel we're getting better bang for our buck. The other benefit is, we can just pick the best ideas out of individual markets. So at times you have expensive markets as a whole, but you can find individual, idiosyncratic credit stories that you really like. Mm-hmm. For us at the moment, to what I was alluding to, the year ahead is very much about carry. So it's about how do you maximize carry while still having an eye on what if some of those risks manifest themselves. So for us, it's what we classify as defensive carry implements. And to what I was alluding to before, the quality end of high yield, so double Bs and single Bs, actually interestingly more so in US than in Europe, that actually still offers some attractive return potential. So we're a little bit more heavily weighted in that. We quite like short duration high yield. Again, one of the aspects of our fund is we try and minimize the impact of interest rates. So to the extent that we saw govies back up, the idea is how do we minimize that impact? And for a short duration, high yield is a great implement. Actually, again, pretty attractive from a carry standpoint. Mm-hmm. And then, the final point worth making is maybe on the structured credit side. So we invest in collateralized loan obligations, or CLOs. Yeah. And there are parts of that market where, again, you're getting very well paid for the risk that you're taking, certainly in the context of what's a fairly favorable fundamental outlook. Yeah. So there are parts of the market that are undoubtedly attractive. For us, it's about how you pull those together in a portfolio which gives you that defensive carry. So we give you, where we feel we can generate that positive return in the year ahead, but still protect on the downside to the extent we hit some of those road bumps.
Yeah, and I think what you've just said there absolutely sums up the need, the desire, the requirement that fixed income investors have at this moment in time. The headwinds are significant. It feels like we're moving into a potential crossroads in time, and it's not as easy as it looks. It's not easy at all. It looks dangerous, in fact, let's be perfectly honest. But to have that ability to go anywhere, not just geographically, but throughout different credits and different structures, is absolutely important. I don't think it's ever been as important in history, and finding that team who has the ability to push forward and deliver a return through these different opportunities is absolutely huge. Jeff, it's been an absolute pleasure talking to you. Thank you very much for your view. You stay safe, and I'm sure we'll catch up soon.
Thank you, Andrew. Thanks to the viewers.